Good morning, friends. So basically what we are looking at here, or what we're going to cover today at the Trade Speakeasy for our morning video, is once again looking at the VIX futures and the put call ratios and comparing value to growth. And we've already talked about these, but now that we're post the Fed meeting, it is interesting or important to kind of visualize what's happening in comparison to years past. So the VIX futures, or the VIX 3-month divided by the VIX 1 month, is basically comparing how much volatility is in the current expiration cycle in comparison to the further out expiration cycle. And when there's a lot of negative volatility, like a lot of down pressure in the market, then usually you will see that ratio start to get really to push low. So if we look back at March, this is the COVID period right around here. And so this is really where we started to see kind of that falling off of our stocks. And until the prices really started to get back to this one line, where it was at least an even amount of volatility in the 1 month as to 3 months out, that's when it kind of released pressure, where we started to see stocks start moving to the upside in a more consistent and even fashion. And normally whenever we get below this kind of one line, it means that there's a lot of pressure on stocks, and it's difficult for them to move in a more even trajectory. So, for those who like to put on bullish strategies, it is better for you when really we're above this 1.10 line, even really the 1.2. That is just showing that there's not a lot of pressure. So there is potential for movement to the upside, because the reality is that, when stocks are moving up, they generally move up kind of slowly. They move up, have a bit of a retrace, move up, they breathe on their way up, like climbing a mountain. But when they fall, it's like jumping off of a cliff. So, you have to be diligent to look at these numbers. Now, the Fibonacci lines, they don't have any relationship to this, but I do like having them on when I'm looking at these kind of ratios where things are moving within a kind of a ratio corridor. So we don't have endless ups and downs. It's kind of like, if we're dividing something by something else, the rate is going to be somewhere between 0 and 2. So if we put on the Fibonacci line, really all that it's helping us do is kind of see where those extremes are and where we really want to be. So as you can see, we had a few periods where we dropped below this green line. And that was where we had, that actually is really, this is really in line with when we have options expiration. And so this is really where we would see the buy the dip crowd come out, especially on SPY or on SPX. So we would have the day before options expiration, we would get a bit, of down pressure, and then we would see things kind of climb back up. But then more recently, we've just not been sustaining those kind of green candles where the volatility is always slightly greater towards the back volatility. So yes, we've been, more recently we have been around here at like the 1.25, but we've had really big swings and not really even movements. So like, as you can see here, we're kind of like moving quite directionally. And so we're consistently the volatility that's in the 3-month period is increasing more than the volatility in that 1 month cycle is decreasing. So we constantly see this like ebb and flow, and it's a much nicer, more smoother movement basically as that volatility is dropping in the front month. And then, we see it again here, but here we're actually getting quite, a lot more volatility in the sense that like that the ratios are just like up and down and up and down. We're not getting those smooth movements back up above this 125 line, where we're just seeing a lot of whiplashing. And that's really hard on stocks to be able to make those kind of even movements, even trajectory. So I did point out to our group that, you know, let's be careful. We're seeing numbers in the 0.90 region, and we're still there. Now we are getting a bit more positivity. So let's see what happens now that the Fed meetings have already taken place, if some of that volatility comes out of this month's actions, and that will really help us maybe find our bottom and then start to head back in a bullish direction. But we do need to find a healthy bottom in the market. So the other thing that you can look at is the put call ratios. And again, just to give us some, you know, some visualization, we'll put on that Fibonacci line just so we have some even rates. But first, let's look at, you know, let's look back at that March period in the pandemic. That will help us. So actually, we need to see a bit more data. So, you know, here is the pandemic, and that is like way at like almost 2, which means that they're double the number of puts to calls. So that's quite an exaggeration. That doesn't really happen very often in normal markets, but let's see. This is really where we're starting to see the put call ratio to be much. This is even. So this is bullish, right? Where you have more calls than you have puts. So people are expecting prices to go up. And normally when we are above this 0.5 area, we have strong bullish movements. But right now we're we're still above that kind of one line. And those are, again, seasons where you have a lot of options expiration and people are expecting a strong retracement or a strong kind of pullback for 1 or 2 days. And as you notice, we usually kind of come up and then we head back towards the means, you know, above that, closer to below the 1. Sorry. And so here we are. We've spent like literally the last 3 days, 4 days, really just hanging around these really high numbers, 0.3, 0.5. And again, that is like almost back to COVID level ratios. Okay, COVID was much higher. So, and the lead up into the COVID period, that was much higher, but still for us, for those who have been trading just in the last 2.5 years, this is really a very significantly high amount of volatility or a high amount of down pressure, because this basically means that people are expecting downward momentum, whether this is long puts or short calls. This is basically what it's telling us, that put call ratio is now pushing downward. So yesterday we hoped that we would start to see a retracement back to the 0.7, but we didn't. We started heading back up to this 1.3, and so there was a bit of corrective movement back to the center, but we're still not in a really healthy territory. It will be nice for us to start seeing consistently printed candles that are less than 0.9 and really less than 0.8. As you see back here, this is where we have consistent bullish trajectory and not so much where we have heavy hedges on. And then you can look at that on PC, which is basically composite. And we are really seeing the same thing, that we're still above here we want to be below 0.6. That's where we see bullish action, but we are still around between the 0.8 and 1.1. So that is still downward pressure for the general, for all the individual underlyings in the SPX, in the US markets, basically. So now if we actually compare IWM to IWN, and this is small caps and small cap growth in relation to small cap value. So as you can see that, during like post COVID, or even like in, around COVID, we were seeing huge movements in the tech sector and in that growth sector. And then we started, but these are small caps, not large caps. So this is not like your Apple and stuff. These are your smaller service companies and so forth. But the growth sector is still tech, fintech, biotech, but small caps. So, then we started seeing that IWM was moving in a window. And so basically, this is the area where value and growth were really competing with each other in the small cap space for strength. But now you can see that really since 2021, while IWM has been range bound, IWN has, well, here it's showing us that IWM is underperforming. So the value stocks are really what is going strong. And that's why this ratio is showing that there is downward movement in the growth sector. Now, if we flip this ratio so that you can see, that value is essentially higher, we do the same thing, but you would put IWN above divided by IWM. And here you'll see the reverse ratio. And basically you see that, into COVID, through COVID, small cap tech was basically beating up value. Then as we started seeing things like the chip shortage and we started seeing a more risk-off environment, then we started seeing value really pump up to the upside in relationship to the growth sector. Now, this is on small caps. So now if you really want to look at large caps, large capitalization companies, then you want to look at IWF versus IWD. And again, we're seeing the same thing, that growth was outperforming. And then it started to have that hiccup, especially during that chip shortage, when the mega cap companies were basically failing or just, flatlining during the whole chip shortage situation. And then right around the middle of the year, when the chip shortage started to ease, we started seeing again large cap growth companies start to outperform value again quite strongly. And now you've seen that there's like just almost a totally downward momentum. And this is really showing that value stocks are heavily outperforming growth stocks, because at least here there was a bit of a, ebb and flow, where you see like we have a bit of up and then a bit of down and a bit of up. So you can see that like, okay, growth is outperforming, but now they're kind of moving evenly. Growth is outperforming, now they're moving a bit evenly. So there's a much more natural movement but then when we see the chip shortage, it's like straight down and value is just pummeling growth. And then here we're starting to see the same thing, that at the moment value is really pummeling the growth sector in the large caps. And so we see the same thing in the small caps and in large caps or mega caps. So really now what it is you have to pay attention for, if you want to really get back in, whether you're dollar cost averaging and trying to hold shares, or you are buying options, you have to be really sensitive to these details. Where is the energy? Where are the dollars flowing? The dollars are obviously not flowing to growth, and they're flowing much more aggressively into the value areas. And then of course on the, if you are really only comfortable, doing bullish strategies, you're not as comfortable, selling call credit spreads or buying puts or, doing short covered calls, things like that, or iron condors or long put butterflies, then you need to wait until we actually see some true bullish activity. And I would really, if I was, if I was taking bets on long positions, like if I was only doing long calls, put credit spreads, short puts, all those things that require bearish movement or long call butterflies, I would need to see this put call ratio really get above the 0.6 when we look at the composite. If we are looking at the put call ratio in just the CBOE exchange, I still need to see that number really be above that 0.8 and stay above it, not just, flicker around, but I need to see consistent action like what we've seen here, where we're really trading within that 0.8 to 0.5 range. I need to see those puts come out of the market. I need to see institutions taking off aggressive hedging. And I really want to see that, we're with volatility, that we're seeing, something above this, really above the 0.15. That is really, that's really great. If we could get above 0.5 and really above, 1.15 or 1.2, this is really great bullish action here and trending action, right? So the problem really is that especially with long calls, you need trending activity to be able to capture a move from support up to resistance, and even through resistance, maybe up to an all-time high. But you need the numbers then to look like this. So you need to really see things that are above that 1.25. And even for, for good trending, like finding good trends, you need to be above the 1.15, but solid trending action, you're seeing that for sure when you're above the 1.25. So, look for those things. Right now, we're just basically like hovering in an area where, any slight movement puts us back into more volatility in the front month than the back month, or the VIX opposed to the VIX 3-month. So anyways, I hope that helps. And I apologize that last time you weren't able to see the screen, but I hope that is helpful and that you'll be able to use that to support some of your theories or your thesis or bias to why you might want to get back into the market if you are sitting on the sidelines. Or for those who are looking for option strategies that really require trending activity, like long calls and long puts, or even debit spreads, then, you really do need to see, we do need to see these numbers get back up if you are looking for long positions, or you want to buy shares, because at this point, there's still a lot of potential for downside weakness. All right, friends, thanks for visiting the Trade Speakeasy. Bye for now.